you're staring at your brokerage account on December 15th. The market's been choppy all year. You're barely up 3%. Your buddy at work keeps talking about the Santa rally, how every December the market goes up like clockwork, how it's free money if you just hold through the holidays. You're thinking maybe you should buy more before this magical run happens. Maybe you should go all in right now, catch this wave everyone's talking about. So you're hovering over that buy button, wondering if you're about to look like a genius or an idiot. Here's what nobody's telling you. You're about to make a decision based on a pattern that works 75% of the time with an average gain of 1.3%. Those are casino odds on a rigged slot machine. And the house? The house always has an edge you can't see. My name is Alex, and I've spent the better part of a decade analyzing market patterns, reading every piece of seasonal research I could find, and figuring out which Wall Street folklore is real and which is just expensive superstition. If understanding what actually moves markets during the holidays matters to you, make sure to hit that subscribe button and give this video a thumbs up. Because today, we're going to dissect the Santa rally piece by piece, look at the real data, understand why it happens when it does, and figure out if you should actually care. Here's my thesis. The Santa rally is real, but it's not magic. It's a statistical artifact with legitimate behavioral and institutional explanations. And more importantly, it's completely useless for making you money unless you understand the conditions that make it work and the years when it fails spectacularly. By the end of this video, you'll know exactly what the Santa rally is, why it happens, when it doesn't, and whether trying to time it will make you rich or just cost you money in taxes and trading fees. So let's start with the definition, because most people throw around the term Santa rally without actually knowing what they're measuring. The original Santa rally, coined by Yale Hirsch in 1972, is incredibly specific. It's not the entire month of December. It's not Thanksgiving to New Year's. It's 7 trading days, the last 5 trading days of December plus the first 2 trading days of January. That's it. That's the window. Hirsch tracked this pattern in his Stock Trader's Almanac and found that during this 7-day period, the S&P 500 rose approximately 75% of the time with an average return around 1.3%. Now, 1.3% might not sound like much, but annualized, that's a massive return for a 1-week period. If you could consistently capture 1.3% every single week, you'd be a billionaire in a decade. But here's the thing, you can't. Because this pattern isn't a law of physics, it's a statistical observation with a bunch of messy human behavior underneath. Let me paint you a picture of what's actually happening in late December. It's December 26th. Most institutional money managers are on vacation. Trading desks are staffed by junior analysts who'd rather be literally anywhere else. Volume is thin, really thin. The big players, the ones moving billions of dollars, they're not actively trading. They're skiing in Aspen or sitting on a beach in the Cayman Islands. Meanwhile, retail investors, people like you and me, we're still watching the market. We're still buying and selling. And in a low-volume environment, small buying pressure creates outsized price movement. It's like trying to push a boulder. When there are 100 people pushing against you, it barely moves. But when those 100 people go home for the holidays and it's just you pushing, suddenly that boulder rolls. That's the Santa rally in a nutshell. Less selling pressure, modest buying interest, thin volume creating exaggerated moves. Now, there are 5 major explanations for why the Santa rally happens when it does. And understanding these is the difference between thinking it's magic and understanding its mechanics. First explanation, tax loss harvesting ends. Throughout December, investors sell their losing positions to capture tax deductions. If you bought a stock at $50 and it's now worth $30, selling it before December 31st lets you claim the $20 per share loss against your gains. This creates selling pressure all month long. But after December 26th, that pressure disappears. Nobody's selling for tax reasons anymore because the window closed. So you get this sudden absence of forced sellers and prices naturally drift higher. It's not that buyers showed up, it's that sellers left. Second explanation, holiday optimism and consumer sentiment. December is peak retail season. Black Friday, Cyber Monday, Christmas shopping. Consumer spending is at its highest point of the year. When people are spending money, they feel wealthier. When they feel wealthier, they invest more. There's a psychological feedback loop where strong holiday sales data makes investors optimistic about corporate earnings, which makes them buy stocks, which pushes prices higher. It's sentiment-driven momentum, not based on actual fourth quarter earnings, which won't be reported until January or February, but on the vibe, on the feeling that things are going well because the mall parking lot is full. Third explanation, institutional window dressing. This one's sneaky. Fund managers get evaluated on their year-end holdings. The positions they hold on December 31st show up in their annual reports. So if a fund manager owns a bunch of losing stocks, they might sell those in early December and buy winners to make their portfolio look better on paper. This isn't illegal. It's not even unethical. It's just optics. But when hundreds of fund managers are all buying the same blue chip winners in late December to make their portfolios look smart, that buying pressure moves markets. Again, thin volume amplifies the effect. Fourth explanation, bonus money flowing into markets. A lot of year-end bonuses get paid in late December or early January. People receive their bonuses and immediately invest a portion. That's fresh capital entering the market right during the Santa rally window. It's not massive capital, but in a low-volume environment, even modest inflows create upward pressure. Think of it like adding water to a bucket. If the bucket's already full, a cup of water doesn't matter. But if the bucket's half empty, a cup makes a noticeable difference. Late December markets are the half-empty bucket. Fifth explanation, and this one's the most controversial, algorithmic and systematic trading. Modern markets are dominated by algorithms that trade based on historical patterns. If a pattern has worked 75% of the time for 50 years, algorithms are programmed to buy during that window. This creates a self-fulfilling prophecy. The pattern works because traders believe the pattern works, so they trade accordingly, which makes the pattern continue working until it doesn't. Because the moment the underlying conditions change, the pattern breaks, and everyone who relied on it loses money simultaneously. We'll get to those failure years in a moment. Now let me hit you with the counter-argument, because this is where it gets interesting. Selection bias is a huge problem with seasonal patterns. The Santa rally data goes back to 1950. That's 74 years of data, which sounds like a lot. But it's really only 74 observations. 74 separate Santa rally windows. In statistics, that's a relatively small sample size, especially when you're trying to predict future behavior. And here's the kicker. The market structure has changed dramatically over those 74 years. In 1950, trading was done by humans on physical floors. Now it's done by computers in microseconds. Retail participation was tiny in 1950. Now retail makes up nearly 30% of daily volume. Tax laws have changed. Retirement account structures have changed. Everything about how markets function is different. So applying a pattern observed over 74 wildly different years to predict what happens next, December is sketchy at best. Then there's survivorship bias. The S&P 500 index itself changes composition over time. Companies get added and removed. The index you're measuring in 2024 is not the same 500 companies as 1950. You're measuring a moving target and calling it consistent. And when you measure a moving target with a small sample size, your statistical confidence should be low. But it's not, because humans love patterns. We're wired to find them even when they're random noise. Let's talk about the years when the Santa rally failed, because this is the part Wall Street doesn't want you thinking about too hard. 2008. The Santa rally window saw the S&P 500 drop over 2%. The financial crisis was in full meltdown mode. Nobody cared about seasonal patterns when banks were collapsing. 2015, basically flat, slightly negative depending on which exact days you measure. December 2018, brutal. The market tanked through Christmas. The Santa rally was a no-show, and investors who bought expecting the pattern to hold got crushed. And just recently, December 2022 saw a negative Santa rally as recession fears spiked and the Federal Reserve kept raising interest rates aggressively. So this pattern that works 75% of the time, that means it fails 25% of the time. 1 in 4 years, you lose money. Those aren't odds I'd bet my retirement on. Here's where the psychology gets fascinating. Yale Hirsch, the guy who coined the term Santa rally, also observed that when the Santa rally fails, the following year tends to be bearish. He called it the Santa Claus failure indicator. If the market doesn't rally during those 7 days, it's often a signal that something's broken underneath. Investor sentiment is too negative to produce even the typical holiday bounce. Institutional money is pulling out rather than window dressing. Tax loss selling pressure is so heavy that it overwhelms any potential buying. A failed Santa rally suggests deeper problems, and historically, those deeper problems often play out as weak or negative returns in the following year. January 2009 was a disaster following the failed 2008 Santa rally. 2019 was actually strong, which was an exception following the weak late 2018 period, but the general pattern holds more often than not. So now the practical question: should you, a retail investor, try to time the Santa rally? Should you buy stocks on December 26th and sell on January 3rd every single year? Let me walk you through why that's almost certainly a bad idea. First, transaction costs. If you're buying and selling within a 7-day window, you're paying trading commissions, spreads, and potentially short-term capital gains taxes if you're trading in a taxable account. Even if commissions are zero, the bid-ask spread on every trade costs you money. You might capture a 1.3% gain, but after costs, you're looking at maybe 0.8%. And that's if the rally happens. Second, tax implications. If you sell stocks for a gain within 1 year of purchase, that's a short-term capital gain taxed at your ordinary income rate. If you're in the 24% federal tax bracket and you make a 1.3% gain, the government takes 0.31%. Now you're down to 0.99% after taxes. Add in state taxes, and you might net 0.7% for a week of market risk. That's not compelling. Third, opportunity cost. To execute this strategy, you need to have cash available to deploy on December 26th. But if you're holding cash waiting for the Santa rally, that cash isn't invested during the rest of the year. The S&P 500 has averaged around 10% annual returns over the long term. Holding cash for 11 months to chase a 1.3% gain for 1 week is mathematically nonsensical. You lose more in opportunity cost than you gain from the rally. Fourth, unpredictability. Even if the pattern has worked 75% of the time historically, you have no way of knowing which year you're in. Are you in the 75% bucket or the 25% bucket? There's no signal that tells you in advance, so you're essentially gambling. And gambling with a 75% win rate sounds good until you realize that the 25% losses can be much larger than the 75% wins. In 2008, the Santa rally window lost over 2%. That wipes out 2 years of 1.3% gains. Asymmetric downside risk is a killer. Fifth, behavioral traps. If you buy specifically for the Santa rally and the market drops, what do? Do you sell at a loss and lock in the damage? Or do you hold and hope it recovers, which defeats the entire point of the short-term trade? Most retail investors freeze when the pattern breaks. They don't sell because selling means admitting they were mistaken. So they hold, and now they're stuck in a position they didn't want for reasons that no longer apply. This is how seasonal trading strategies become accidental long-term disasters. The real magic happens in your brain when you understand that markets are not machines. They're auctions driven by human behavior, institutional rules, and algorithmic momentum. Patterns exist because conditions repeat, but conditions change. The market structure of 2024 is not the market structure of 1972 when Yale Hirsch first documented this pattern. High-frequency trading didn't exist. Retail options volume didn't exist. Passive index fund flows were negligible. All of those things fundamentally alter how seasonal patterns express themselves. Algorithms now front-run every known pattern. If the Santa rally is predictable, algorithms buy in advance, which pulls the gains forward, which changes when the rally happens, which eventually breaks the pattern altogether. This is called alpha decay. A strategy that works becomes known, becomes crowded, stops working. Let me address the emotional resistance you're probably feeling right now. You're thinking, but Alex, if it works 75% of the time, shouldn't I just play the odds? And I get that. It's tempting. It feels like an edge. But here's the hard truth. Your edge is being eroded by transaction costs, taxes, and the fact that you're competing against algorithms that execute this trade faster, cheaper, and with better risk management than you ever could. You're not playing against the market. You're playing against Goldman Sachs' trading desk, Renaissance Technologies' quantitative models, and every other sophisticated player who's already priced this pattern into their strategies. By the time you're reading about the Santa rally on Reddit or watching a YouTube video about it, it's not a secret. It's public knowledge, and public knowledge has no edge. Now, there's a distinction between understanding the Santa rally as a market phenomenon and trying to profit from it directly. Understanding it is valuable. It helps you contextualize price action in late December. If the market's up during the Santa rally window, you understand why: low volume, tax dynamics, sentiment. If it's down, you understand that might be a warning signal about the following year. That contextual knowledge is useful for managing your existing portfolio. But that's different from making a trade specifically to capture the rally. The first is education. The second is speculation. And speculation on a pattern with a 25% failure rate and high transaction costs is a bad bet for retail investors. Here's what you should actually do instead. First, ignore seasonal patterns for trading decisions. Your investment strategy should be based on your financial goals, risk tolerance, time horizon, and asset allocation, not on a 7-day window in December. If you're a long-term investor, which you should be, the Santa rally is noise. It doesn't matter. You're holding for years or decades, so a 1.3% move in 1 week is irrelevant. Second, use the Santa rally as a sentiment gauge. If the market doesn't rally during the typical window, pay attention. That might signal underlying weakness worth investigating. Are earnings expectations being revised down? Is economic data deteriorating? Is there a policy shock coming? A failed Santa rally can be a yellow flag that something's broken. But the solution isn't to sell everything. It's to reassess your positions and make sure your portfolio is still aligned with your goals. Third, maximize tax efficiency year-round, not just in December. Tax loss harvesting should be a continuous process, not something you cram into the last week of the year. If you have losses in June, harvest them in June. Don't wait for December. And if you're harvesting losses in December, don't buy back the same stock immediately or you'll trigger the wash sale rule and lose the tax benefit. Be strategic. Be deliberate. Don't trade based on the calendar. Fourth, understand that low-volume markets are dangerous for retail traders. The same thin volume that creates the Santa rally also creates wider spreads, more volatility, and less liquidity. If you need to sell during the holiday week for any reason, you might get a worse price than you would in a normal market. Low volume cuts both ways. It amplifies gains and amplifies losses. It's not your friend just because it sometimes pushes prices higher. Fifth, focus on boring consistency over exciting patterns. The Santa rally is exciting because it's predictable and short-term, but exciting doesn't make you wealthy. Boring does. Consistently investing a portion of every paycheck, holding low-cost index funds, rebalancing annually, and not panicking during downturns will build more wealth than chasing any seasonal pattern ever could. The math is simple. Compound returns over decades beat short-term trading gains over weeks, every time, without exception. Let me tie all of this together because when you see how these pieces connect, everything changes. The Santa rally is real in the sense that there's a measurable statistical tendency for markets to rise during the last 5 trading days of December and the first 2 of January. That tendency has held about 75% of the time for the past 7 decades. The explanations for why it happens: tax loss harvesting, low volume, sentiment, window dressing, bonus flows, are all legitimate and logical. But legitimate and logical doesn't mean exploitable, because by the time you factor in transaction costs, taxes, opportunity cost, and the risk of being in the 25% failure bucket, the edge disappears. You're not beating the market, you're losing to friction. Yale Hirsch gave us a useful framework for understanding seasonal market behavior. The Santa rally is one piece of a broader calendar-based analysis that includes the January effect, the sell in May pattern, and others. But Hirsch himself was clear. These are observations, not guarantees. They describe what has happened, not what must happen. And the failure indicator, the idea that a missing Santa rally predicts bearish years ahead, is a warning system, not a trading signal. It tells you to be cautious, to pay attention, to reassess risk. It doesn't tell you to sell everything or go to cash. Context matters. Conditions matter. Blindly following patterns without understanding the underlying mechanics is how retail investors lose money. So here's your takeaway. Appreciate the Santa rally as a fascinating piece of market history and behavioral finance. Understand why it happens. Use it as one data point among many when assessing market conditions. But don't trade it. Don't try to time it. Don't restructure your portfolio around it. The costs exceed the benefits for the average investor, and the unpredictability of which years fall into the failure bucket makes it a gamble, not a strategy. If you want to build wealth, focus on the fundamentals, earn more, spend less, invest consistently, minimize taxes and fees, diversify broadly, and let time do the heavy lifting. That's the real Santa rally, the gift of compound returns over decades, not the illusion of free money in 7 trading days. Your future millionaire self is counting on you to make smart decisions based on evidence, not folklore, to understand the difference between a statistical pattern and an actionable edge, to resist the temptation of chasing easy gains and focus instead on the boring, reliable path that actually works. 10 years from now, you won't remember whether the Santa rally happened in December 2024, but you will remember whether you stayed disciplined, kept investing, and built a portfolio that compounds wealth year after year regardless of what any 7-day window does. That's the real gift. That's the rally that matters, and that's the one you control.